In this video, I'm going to teach you how to use the 15-minute time frame for the easiest entry model for fair value gaps. And if you watch the whole video, you'll get a free FVG cheat sheet that you can download and use in your own trading day to day. As intraday traders, the 15-minute time frame is one of the best time frames because it still gives you a range large enough to catch a decent trade. So for an example, from the high of this 15-minute impulse down to the low, that is still 220 points that you can catch a great trade within. So how do we trade fair value gaps on the 15-minute? Well, the first thing is always going to be time. As you can see, this green vertical color in the background is New York session open. I always wait for the New York open to trade in Q, and better yet, I wait until the CME open to see what the true move for the day will be. As we can see here at 8:30, we get a huge impulse to the downside, running multiple short-term lows in this area. You can also call this impulse a displacement. So now the next step is we need to see a fair value gap close, which happens after we get the first, second, and third candle that closes and leaves a gap between price of the third candle's highest point and the first candle's lowest point. So if we were to draw a zone that highlighted that range, we can now see that all of this area still technically needs to be filled in. So how do we trade this? The first step is dragging your fib over the fair value gap. This gives you a range of the premium and discount of that actual range. Now, keep in mind, there's different ways to trade fair value gaps. It may not always retest the 50%, 75%, or 100%. And the way we can know how to refine this is actually on the 1-minute time frame. So what we're going to do is drop down on the lower time frame and look at this area. As we can see here, we have multiple signs that the market is about to roll over. We have a very strong rejection candle that makes a wick to the top side. We close our first bearish order block in this range. And from that bearish order block, we actually see a retest and a short-term low being ran here. This is starting to give us what I call order flow switch principles. When we stop making wicks to the bottom side, instead make them to the top. When we start maintaining bearish order blocks and we start running previous bullish order blocks or short-term lows, that is telling you that the market is going lower, seeking sell side liquidity. So the next thing we want to look for is a sell side imbalance. Did you already spot it? It's right here. So if we draw a zone off of this bullish candle's lowest wick and this third candle's highest wick, we can see that we have a fair value gap range that price is now going to retest into and respect. So now we can place a short on this trade either by using a market order or a sell limit, place our stop loss above the previous bearish order block high, and simply target a 1 to 3 for our first target. Now, if you want it to be fancy, we can also see that we printed new fair value gaps in this range here. So if we were to draw a fib from this high to this low now, representing the last impulse leg, we want to see price retest above the 50%, which would be in premium. And we can see that even this lower fair value gap is still technically in premium, which means when we retest into it, this can be another entry for a sell trade. In this scenario, the next bearish order block would be way up here, about 12.75 points away. So instead of using that method, what we can do is place our stop loss above the candle that created the fair value gap. So it would be the second candle. And the reason it would be the second candle is because we have this first candle, this second candle opens, right? And then the third candle does not fill in the range in between the first and the third candle. So in this scenario, if we place our stop loss above this second candle, we should be able to see it maintain, because if it breaks above this candle, it's no longer maintaining the actual fair value gap. And as you can see, with a tight stop on this trade, we're able to maximize for a really great risk to reward of about a 1 to 14, but let's be realistic and say we targeted the same 1 to 3 as before. We were able to get two 1 to 3 risk to reward trades out of this same reversal coming from a 15-minute fair value gap. The last thing I want to point out is the best entries are always going to come from the first retest to the M15 fair value gap. So for an example, when price came here, this is the first retest. So the best entries are going to be coming off of that impulse leg. Now, once we start retracing such as this, it's not to say that there won't be great entries, but as you can see here, there was a lot of back and forth movement before we had another impulse to the downside. And that I'll save for another video on how to catch continuations with fair value gaps. If you're interested in learning more about how we use fair value gaps in our own trading, you can actually join our live trade room by clicking the link in the description and get 7 days free, no credit card needed, and no commitment. See you inside.